Hello, I am Hilary Graves of Bright Sound Investments.
Hi there. I am Ian Schmidt with Mapleton Capital Group. You've probably heard about the recently passed One Big Beautiful Bill. It is a sweeping tax package that has some pretty big implications for the entire investment landscape, small business owners, high earners, and especially real estate investors. Today, Hillary and I are going to touch on some high level insights on what the bill includes and what it could mean for you.
But first, we want to give a disclaimer. We are not CPAs, we are not tax advisors, and this is not tax advice. Always consult a licensed tax professional for your personal situation. We are just here to share insights and ideas that could help you build wealth through real estate. All right, let's jump into it. Number one, permanent 20% deduction on income. This is also known as the QBI deduction. This allows certain taxpayers to deduct up to 20% of their qualified business income from a domestic pass-through entity. Not everyone qualifies. There are some key rules and exceptions. When you invest in real estate, including when you invest passively, your share of income flows through to you on a K1. That income qualifies for something called the qualified business income, the QBI deduction, which lets you deduct 20% of that income before it's taxed. That deduction was set to expire soon, but this new bill actually makes it permanent, at least until there's a change of legislation. So instead of paying tax on 100% of your share of profits, you might only be taxed on 80%, depending on your income level. And what that means for you is that you'll have lower effective tax rates on your real estate income, and that can equal better after tax returns. But like I said, not everyone qualifies. You're more likely to qualify if your rental activity is considered a business, and that's even if it's passive. Without getting too far into the weeds, this means that you'd have to keep separate books, records, 250 plus hours of rental services that have been performed by you or others, just to be eligible for this deduction. But that said, many investors can and will take advantage of the QBI deduction.
Thanks, Hillary. One of the most significant changes to this entire bill was the extension of the 100% bonus depreciation. And that's where real estate really shines. So, what is depreciation? It's a gift from the government. Essentially, the government knows we need housing, and instead of doing it all themselves, what do? They partner with real estate entrepreneurs like us in order to provide more housing. And what it does, it allows real estate investors to deduct the theoretical wear and tear on a property over time, even as its market value often increases. It reduces the taxable income without requiring any real outlay of cash. So, without question, it is one of the most powerful tools for building wealth and shielding income legally. So, with this bill, 100% bonus depreciation is back, and it's actually extended through 2029. This means that when we require a property, we can continue using cost segregation studies to accelerate depreciation and claim big deductions in year one. The last time it was 100% was in 2022. And then earlier this year, it was actually only 40%. So the bill got passed and now it's back up to 100 from 40. So super duper significant. And it's counterintuitive because even though the property is generating income, your K1 could very well show a paper loss, which is going to help offset taxes on that income. Whether you are an active or a passive investor, this means that there's higher upfront tax deductions. Often there is zero taxable income even while you're receiving distributions, and it's potentially going to lower your taxes on other passive income if you qualify.
Number three, Section 179 lets us immediately deduct the full cost of certain improvements. So things like appliances, HVAC systems, flooring. The new
Mhm.
bill more than doubles the limit from around 1 million to 2.5 million, and it raises the threshold for when the deductions start to phase out. That gives us even more flexibility to invest in value add improvements while maximizing the tax benefits. Again, helping to reduce your taxable income while increasing property value.
All right. And lastly, this is not a change. It's actually going to relieve many folks that the 1031 exchange has remained intact. I feel like most even beginner real estate investors are going to be familiar with the 1031 exchange, but essentially what it is it's a strategy that's going to allow real estate investors to defer their capital gains taxes when they sell one investment property and reinvest the proceeds into another like kind property. There were speculations that the 1031 was going to be capped, maybe around 500,000 a year. We heard possibly a million a year. And then other folks thought that it would actually even be eliminated for high income investors or restricted for certain types of properties. But despite the concerns, the actual 2025 bill does not impose any new restrictions, caps, or limitations on 1031 exchanges. Section 1031 continues to allow real estate investors to defer 100% of capital gains by rolling the proceeds into like kind properties, including the option to exchange into multiple replacement properties and conduct exchanges indefinitely as part of a long-term wealth building strategy.
Bottom line, as real estate investors, active and passive, the Big Beautiful Bill gives you permanent income deductions, extended accelerated depreciation, more aggressive tax write-offs on property improvements. All of this adds up to more tax efficient returns and a stronger reason to keep real estate in your portfolio. As always, if you want to see how this might impact your specific tax situation, definitely talk to your CPA. And if you have questions about how we're putting these tools to work in upcoming deals, just reach out. We hope that you found something valuable in this video, and we'll see you on the next one. Take care.